So thank you guys for joining. We are going to talk about portfolio construction today. We'll get into that in a second. First, our housekeeping items. So anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice, but would love any questions. So if you have any questions, there's a Q&A button down at the bottom of the screen, or you can send them in the chat. The other thing is, if you're over in New Zealand and you want a copy of our FAP, you can go to our website, morningstar.com.au, to get that. And the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you want personal advice. And for anyone who is watching this on Instagram or Facebook, you can send questions to Will, who will then send them to me. It will be this exciting game of, I don't know what, like telephone, whatever that game is, you used to play as a kid. And Will, for those that don't know, is our videographer and the producer of our podcast, and he's in the office today, so I'm not as lonely, which is why you came in, right, Will? Yeah. All right. So let's talk about constructing a portfolio. So we've got this topic today, and we're going to talk about how you set up goals, calculate your required rate of return, think about asset allocation, and then on Tuesday we're going to talk about how to find funds and ETFs. So it'll just be a nice little tie-in, hopefully. That was the plan, at least. So we are going to do things a little bit differently today once I can find my screen that I want to share. Okay, here we go. All right, so the first thing we need to talk about is goals. So we're going to go through a couple different steps today. Defining goals, calculating your required rate of return, selecting asset allocation target. We'll quickly talk about selecting investments. We'll really save that for Tuesday, and then maintaining your portfolio. So hopefully everyone can live with the suspense over the weekend of, not knowing that fund and ETF, webinar. Okay, so let's talk about defining goals. Now, Morningstar, we are proponents of goals-based investing. And the simple reason for this is we are all investing for a reason. This is not generally to just add zeros to the end of your net worth. It is because you want to do something in the future. You want to support your family. You want to have the retirement of your dreams. Whatever your specific reason whatever your specific reason for investing in, that's of course up to you. So we want to focus on those goals because that's what we are trying to achieve. And as we go through this, we'll talk about some different approaches that people take to investing and why we don't think that that's very effective. All right, so now when we define goals, we need to be specific about what we are defining. Now, a lot of people say, how am I supposed to be specific if something is way out in the future? This does not mean you can't change your goal or adjust your goal over time. But trying to be specific, at least what your vision is right now of what this goal will be, is really important because it's going to inform all the decisions you make as an investor, namely decisions around asset allocation and decisions around the securities you're going to select. All right, so when we say define a goal, what do you need to do? Well, you need to come up with 4 very specific things. And the reason you need to come up with them is because that is going to go into a formula. So what are the 4 things you need to come up with? So you need to come up with how much will your goal cost. We'll get back to that one in a second. When do you want to achieve your goal? So that is the date. How much have you saved already? So you need to know what you've got. And then, of course, how much can you save in the future? Now, obviously, all of these can be adjusted. It'd be very hard if you were 22 years old and thinking about saving for retirement to have any idea how much you will make or save later in life. But the point is that you can make adjustments as you go along. Sorry, I'm trying to find another screen to share, which, as people who have done this, have been on these before, know is very challenging. Challenging for me, at least. I have too many screens open. Anyway, I will find it. Okay, so let's talk a little bit about how you estimate how much you need for goals. Well, there are 2 real goals that you can have. So you can have a goal where you immediately spend all of the money. So that can be a goal like a house. All right, so that's hopefully a little easier for you to estimate how much you'll need. You can go out and look at what houses cost and they only go up about 20% a week in Australia. But you can figure out how much a house costs, and that's sort of an immediate goal where you need a set amount of money, and that set amount of money will of course go to pay for a down payment on a house. The other type of goal is a little harder to estimate, and that's around something like retirement. And that is a goal where, sure, you need a set amount of money, but then you need to translate that back into living expenses, because that's what retirement is. It's taking your portfolio and using that portfolio to come up with, to generate a certain amount of withdrawals that you can use to fund your life. So let's talk about how you do that. Really what you need to do is you need to look at what is the yearly amount, the annual amount of money that you need to survive. And then, of course, we can just calculate how much we need for that goal by dividing it by a withdrawal rate. So let me go through a couple of these concepts. How do you calculate how much you need? Well, generally what people look at is something called a replacement rate. A replacement rate is how much of your current salary do you need to replace in retirement. And a couple factors that go into that. We did a whole webinar on retirement, but a couple factors that go into that are obviously what sort of life you envision living in retirement, but also you need to look at your tax situation, and you need to look at how much you're saving, because your taxes generally dramatically go down in retirement, especially if you've been saving in super and you want to use super to pay for your life. And of course, you don't have to save money in retirement generally because you've already saved it. Now you're spending money. So those are the different things you want to think about in terms of a replacement rate. Generally, and the interesting thing about a replacement rate is because we have marginal tax rates that go up as you earn more money, the more money that you earn, the lower your replacement rate is. But think about your replacement rate. So a rule of thumb that people use is 70%, right? If you start thinking about how much you save, how much you pay in taxes, around 70% seems to be a ballpark figure for people. And then we have to think about the withdrawal rate. So the withdrawal rate is how much of your portfolio you take out every year to pay for your life. Now, 4% is thrown around there. We've done whole webinars and podcasts on 4%. But whatever that withdrawal rate is, and you're trying to come up with a safe withdrawal rate that will enable you to not outlive your money, whatever that withdrawal rate is, all you have to do is a little bit of division, divide the amount of money that you think you need per year in retirement by your withdrawal rate. So if it's $100,000, then you can take $100,000 and you can divide it by 4, and that gives you a $2.5 million portfolio. So that's a way. Did I just disappear? No, someone else disappeared. That's a way that you can. That's a way you can estimate how much you need. All right. So we're assuming that you've gone through all of this. So I am going to share the screen that I was trying to find. We have a goal setting feature in Morningstar Premium. Now, there are ways to do this without Premium, obviously, and I can walk through those and answer questions on that. But you can just use a financial calculator as well. But let's set up a goal. So the reason that we are trying to be very specific about all those inputs into a goal is because we want to calculate the required rate of return. So that's why we need all those inputs, because there's a formula that we're trying to use. So what this is the time value of money formula, which basically tells you how much a dollar today is worth in the future. And we have, if anyone remembers algebra, we basically rearranged the formula to solve for the return. So the return that gets you from the amount of money you have today to what you want in the future based on how long that period is when you want to achieve your goal, and also including how much you want to save. So let's use an example. So if we're sitting here, so let's use that $100,000 example. So if we're using $100,000 at a 70% replacement rate, that means that we need $70,000 a year. So if we divide that $70,000 by 4%, if we want to use 4%, hold on, my calculator, if we want to use that 4%, so we come up with 1.75 million. So I can put that in my future value, right? So that is how much I want in the future. I want 1.75, not 4. Starting value, we're obviously just making things up here, but let's say we have $450,000, and let's say we have 20 years until retirement. So this is the time horizon until my goal. And why don't we say that we save on an annual basis, we save $10,000. All right, so what does this give us? This gives us a 5.8% return. So what that means is that if I am saving $10,000 a year, I have $450,000, I want to get to 1.74 million. For 20-year time horizon, I need to earn 5.8%. Now, one very important thing that we did not include in this is, of course, inflation. So inflation is very important. We know that $1 today, it's especially important if anyone tuned in on Tuesday, because we're starting to see signs that inflation might be picking up a little bit. But we know that the spending power of $1 reduces over time. So I had to put in an inflation rate. So why don't I put in 2.2%? So what is that doing? It is going to inflate this dollar figure. Now, there's a couple ways you can do this. So if you think about what we've just done, it is easy generally for people to figure out the lifestyle that they can live on a certain amount of money today, right? Because you understand how much stuff costs. So if somebody comes and tells you that this is the lifestyle you can survive on today, it's generally easy for us to figure out, but we need to take inflation into account. So what I've done is I've just set up my goal based on today's dollars. Then I've added in an inflation rate. So over 20 years, that's the inflation rate. You could also do this with the dollar figure if you wanted, the dollar figure you want for a year. I could have taken that $70,000, put an inflation rate on it to see what it would be in the future. But anyway, we've come up with 8.3% for a required rate of return. Now, why is this an important number to calculate? There's a number of different reasons. The first reason is this will tell you if your goal is realistic. So you need a realistic return on here to be able to achieve your goal. So if you go through and you figure out what your goal is, you define your goal. So let's say I decide that I want $10 million. I want my retirement to be a little better. All of a sudden, I've got to earn 18.7% a year for the next 20 years. So for people that have invested longer than the last year, even though things have gone very well and you would have exceeded this, that's impossible to do unless you are Warren Buffett or running some sort of hedge fund. So that's very, very difficult to do. So in this case, you would know that that goal is not achievable. So what do you need to do if you have an unachievable goal? And I'm obviously using an extreme example here. You need to adjust a couple things. So you can adjust the amount of money you have. You can adjust your investment. So, okay, well, what if I save $100,000 a year? That's still a really high number. What if I save $400,000? Okay, well, this is more realistic. So if I can somehow save $400,000 a year, now I have a lot smaller minimum required rate of return. So that's what we're trying to do. Number one, sense check if our goal is actually possible. So we can use the required rate of return to do that. The other thing that we could do is we can use this then to inform decisions we make around asset allocation. So asset allocation is how you allocate assets at a high level amongst growth and defensive assets. And then as we build out more detail around different asset classes. So things like Aussie equity, global bonds, Aussie bonds, et cetera. So the reason we want to use this number to inform our asset allocation decision is because we want to create a portfolio that has a possibility of achieving your goal. The way a lot of people do this is they use a risk tolerance questionnaire where they go out and they ask you how much risk can you withstand in your portfolio? And then they'll decide if you should be in a conservative portfolio with lots of defensive assets or an aggressive portfolio with lots of growth assets. But just doing this risk tolerance questionnaire really doesn't solve any of your problems because we're not focused on what you need to achieve your goal. So that's the difference between risk tolerance, how much risk tolerance you have, and risk capacity, the amount of risk you need to take on to achieve your goal. And one thing that in study after study after study has been shown is men and women respond very differently to risk tolerance questionnaires. So women get put in a lot more conservative portfolios than men. Now, we know that this is ridiculous, right? So whether men are taking on too much risk or women are taking on too little risk, we do know that men and women's goals are probably not different, right? Individually, they could be different, but across the population and across these studies, they should not be different. And this just demonstrates the fact that there are gender differences in risk tolerance questionnaires and then gender differences in how conservative portfolios are. That just shows the whole process doesn't work, right? Because it's not focused on you, it's not focused on your goals, and framing those discussions around goals will allow people to realize that they do need to take on a certain amount of risk, right? That you can't put all your money into a bank account and expect to be able to retire comfortably. So that's, that is the, that's the required rate of return, and we'll get into asset allocation in a second. We've got a couple questions. So we've got a question from Andrew that wants to talk about the replacement rate again. All right, so let's go back to that. Let's go back to the concept. So very simply, that if I was retiring tomorrow, I need to replace the money I make from my job with withdrawals that come out of my portfolio, right? So instead of my employer paying me, and there's all sorts of nuances, right? You could be on the age pension, for example. You could be, you could have other sources of income. But in a simplistic example, where tomorrow I need my super fund to pay for my life, I need to think about how much a year I need. So it's pretty simple. I mean, simple is probably the wrong way to describe it. So think about how much you make now. Think about the lifestyle that you live now. Are there going to be changes? So a change in lifestyle, of course, could be you could move somewhere cheaper where the cost of living is less expensive. There's all sorts of different adjustments you can make. But let's say you wanted to live the exact same life. I want no changes in my life. I want to quit my job, have the same amount of money in my bank account every month to pay for my life. So what does that mean? That means on the surface, you have a 100% replacement, right? That if I make $100,000 now, I need my portfolio to generate $100,000 a year. But that's also not completely realistic because a couple things are going on with me right now. So if I'm at retirement age, I pay taxes on my salary right now. If I get my money to support me out of a super fund, all of a sudden, and I know there are extenuating circumstances, but all of a sudden I'm paying 0% taxes because I'm taking money out of my super. There will be 0% tax when it comes out of my super. So, okay, my taxes go away. So I'm looking at after-tax salary, what's important to me. So if I think about my salary, all of a sudden taxes go away. Also, let's say you're putting the required contribution into super. So that's another 10%, right? That I don't need that 10%. So those are ways that automatically, even if I want to replace 100% of my lifestyle, that your replacement rate goes down. And you can go on to paycalculator.com.au is an example. You can go out in there and put in your salary or put in whatever salary you want to earn. And it will show you the amount that you need after super. So if you divide those two, after super and after taxes, because it'll show you your taxes, your marginal tax rate as you make more money. So you go in there, put that in, and you can see if $70,000, if I make $100,000 and $70,000 comes out after taxes and super, then my replacement rate is 70% of my current salary. And I know that I need $70,000 a year. So hopefully that helped. Okay, so good. Another good point by Michael, and then I'll get to your first question in a second. So Michael's saying the only problem I see with this and what we're doing is it doesn't take into account income tax. You're going to pay tax on the income generated, so the future value will be affected. Right. Okay, so the minimum required rate of return that you come up with needs to be the rate of return that you earn after taxes and after fees, right? So that's why we need to be careful when we look at this, right? So we can go back and look historically. So in the past 120 years or so, in a nominal basis, so not counting inflation and including dividends, the Aussie stock market has generated around 10% a year. But remember that 10%, for you to go out and get that as an investor, depending upon the way you do that, you are going to have to pay fees and you're going to have to pay taxes along the way, right? You'll have to pay taxes on those dividends. You'll have to pay taxes on any capital gains that are generated. So this needs to be an after-tax, after-fee return. It's another reason why you need to be really careful that this number is not too high, right? Because even all the returns that we get quoted are all returns generally before fees and taxes, right? When we sit there and look at indexes and people tell us that the index went up 26% this year, well, you're probably gonna have to pay taxes if you trade a lot or if you get distributed capital gains. So that's a really, really good point, Michael. Okay, I'll get to the next questions in a second. So we have a minimum required rate of return. So now what are we doing? Now we need to look at asset allocation. So once again, asset allocation is the mix between growth and defensive assets. So the higher that required rate of return is, up to a degree where it's not possible for you to achieve it, the higher that is, the more growth assets you need to have in your portfolio. So as investors, we exchange risk for return. And we'll talk about what that risk is in a second. But the more risk we take on, the higher the expected returns. That's why cash, if you put cash in the bank, a simplistic example, but an accurate one, if you put cash in the bank, you will earn almost no return. But there's also no risk that your cash is going to go anywhere, right? So it's in the bank. If the bank fails and it's under a certain amount, the government steps in, gives you your money back, right? So there's no risk that you're going to lose your money, but you get almost no return. Then on the other side of things, of course, we have shares. If you go out there and buy shares, there is going to be risk that that value is going to fluctuate, but you get a higher expected return. So this is informing those choices that you make. And that's why the choices you make between growth assets and defensive assets should be based on the return you need to earn. So if you calculated this, and let's say you came up with 1%, you're in a very good position there, right? If you need a 1% return a year over 20 years, you're in really good shape. You don't have to take on any risk, right? So you could probably figure out how to do that just using, a mixture of bonds and cash. So that would be a really good position. You wouldn't have to take on risk, but most people have to take on risk in their portfolio. And that's why, going back to this example, if you're in a very conservative portfolio because you're scared about fluctuations in value, volatility, then that's fine, but you're not going to achieve your goal. So that's why we want to frame this around your goal. All right, so let's talk about the risk that's associated with a portfolio. When people in the investment industry talk about risk, they're talking about volatility. They're talking about how much your portfolio bounces around in value. So shares are very volatile, right? So when I go and look at the share market every day, I can see that it's bouncing around a lot. Okay, so maybe went down yesterday, goes up today. That's volatility. Now, volatility doesn't really matter for most of us because if we're investing for a very long time horizon, who cares? If I'm investing in this example for 20 years from now, who cares what the share market does? So it can have big drops, it can go up a lot. It doesn't really matter because I'm very focused on where I am in 20 years. Now, the problem with volatility is that it causes us to do dumb things as investors. It causes us to sell at the bottom of the market. It causes us to invest all of our money in Bitcoin at the top of the market. That one's for Will. But volatility shouldn't matter other than, well, as long as you can prevent yourself from doing something dumb and staying invested and sticking with your plan, volatility shouldn't matter. All right. Let's move on to asset allocation. So we will cancel out this goal. By the way, if you are a premium subscriber, you can save your goal. So I've saved some, which I'll show you later why you want to do that. So let's look at asset allocation. All right, so we have 5 different model portfolios on here. Everything from conservative, they're not model portfolios, or suggested asset allocation, to aggressive. So we'll go in aggressive. So let me just talk about, once again, this concept. So if I need to earn a 8.8% return, now that is high. So I'm telling you that is pretty high, especially when we start talking after tax, after fees. But if I need to earn that return, I need most of my portfolio in aggressive assets, growth assets. So you can see this portfolio has 90% exposure to growth assets. And that, of course, for those that can do math, leaves 10% for defensive assets. And so what we've done here is we've broken this down into different asset classes. So everything from growth is obviously the equity portion of things, defensive, fixed interest, and cash. Now, why do we do this? Why are we looking to invest in different asset classes, and why are we diversifying? So in asset classes and then diversifying further. The reason we're doing this is because we, of course, don't know the future, and we don't want the risk in one of these associated, so unsystemic risk, right? We need to take on risk on an aggregate term, but we don't want unsystemic risk to destroy our investments in any way. So a perfect example of this is Japan. So if at a country level, if I lived in Japan when the Nikkei hit its high in like 89 or something like that, I thought, this is great. Why would I invest anywhere else? I'm Japanese. I want to invest in my local market. This is what I'm going to do. Well, 25 years later, the Nikkei, 25 years later, right, a quarter of a century, the Nikkei was at 50% of what it was in 1989. So what I want to do is I want to diversify away that unsystemic risk, in that case of just investing in Japanese shares. Same reason why I don't want to put all of my money into one company, because it could go bankrupt. So that's why we are diversifying. So we're diversifying into different asset classes, and we diversify further underneath that. But this is just an example of a portfolio and how you should think about these decisions, right? We're trying to buy things that have expected returns that will allow us to achieve our goals. Thank you guys for joining. If anyone has any questions, you can email me. It's mark.lamonica1@morningstar.com. Appreciate you guys joining. And now we are going to record a podcast, which you can listen to on Sunday. So thank you guys.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.